The year is 2025. Global debt isn't just a problem, it's a ticking time bomb. Trillions upon trillions of dollars, euros, and yen weighing down nations, threatening to detonate the very foundations of the world economy. Are we on the brink of an unprecedented financial crisis? For years, we've heard warnings about the debt crisis in developing nations. But a more insidious threat is emerging. Developed economies, once considered pillars of stability, are now grappling with staggering levels of sovereign debt. The numbers for 2025 are alarming. The latest OECD Global Debt Report 2025 paints a stark picture. Aggregate central government marketable debt in OECD countries is projected to hit 85% of GDP. That's more than 10 percentage points higher than in 2019 and nearly double the 2007 level. This isn't just about the sheer volume of debt, it's about the cost. Interest payments are now consuming an alarming portion of government budgets, exceeding even defense spending in OECD nations on aggregate. And the clock is ticking. A colossal wave of refinancing looms. Nearly 45% of sovereign debt in OECD countries, and roughly 1/3 of all corporate bond debt, is set to mature by 2027. This means governments and corporations must borrow again, likely at higher rates. Adding to the volatility, central banks, who were major buyers of government bonds for years, are now withdrawing from these markets. This leaves a vacuum, with households and foreign investors stepping in, potentially increasing price sensitivity and market instability. Historically, unchecked debt spirals have led to devastating consequences. Think of the 1980s Latin American debt crisis, or the European sovereign debt crisis of the early 2010s. While contexts differ, the fundamental strain on public finances and loss of investor confidence echo loudly. In the Eurozone, the fear of contagion, where one nation's debt woes spread to others, nearly tore the union apart. Austerity measures, bailouts, and immense political will were required to avert catastrophe. Could we see similar pressures emerge, even in seemingly strong economies? Today, major economies are at the forefront of this risk. Japan, with a staggering debt-to-GDP ratio of 260%, faces deepening fiscal strains. Its 20-year government bond yields are trading near their highest since 1999. The United States, the world's largest economy, holds the biggest debt at $38 trillion, representing 125% of its GDP. With continuous fiscal deficits, projections suggest public debt will only continue to climb. Across Europe, despite some stabilization, countries like France and the UK are seeing their public debt levels rise. The UK, in particular, has seen government interest rates increase as the Bank of England unwinds its quantitative easing policies. The current economic vulnerabilities are multifaceted. Persistent inflation, subdued global growth projected at 3.2% for 2025, geopolitical conflicts, and ongoing trade tensions all combine to create a volatile environment. In this landscape, fiscal vulnerabilities and potential financial market corrections are not distant threats, but immediate concerns. The IMF warns that global debt could surpass 100% of the world's GDP by 2029, potentially sooner if growth falters. So, what are the potential future scenarios? Scenario 1, a slow, grinding deleveraging, painful but manageable, requiring significant fiscal discipline and perhaps some economic stagnation. Scenario 2, a sudden shock, a black swan event, triggering a full-blown sovereign debt crisis in one or more developed nations, leading to global financial market turmoil, possibly even a recession. In these scenarios, who wins and who loses? Investors holding short-term government bonds in stable economies might fare better. Those heavily invested in longer-term, higher-risk sovereign debt or vulnerable corporate bonds could see significant losses. For citizens, the implications are profound. Higher taxes, reduced public services, and inflationary pressures could become the norm. The burden of interest payments could directly impact quality of life, diverting funds from essential sectors like healthcare and education. Governments must act with credible, transparent, and sustainable policies. Rebuilding fiscal buffers, preserving central bank independence, and pursuing structural reforms are critical. For investors, diversification and a vigilant eye on sovereign credit ratings are paramount. As individuals, understanding these macro trends is key to personal financial resilience. Consider your debt exposure, diversify your savings, and advocate for responsible fiscal policies from your leaders. The global debt crisis of 2025 isn't just a headline, it's a defining challenge of our time. Stay informed, stay prepared, and let us know your thoughts in the comments below. Don't forget to like and subscribe for more in-depth economic analysis.